Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. In recent days, the collapse of the Silicon Valley Bank (SVB) has rocked the banking sector, raising concerns about the causes and ramifications of such a failure. Bank collapse. What does it mean for the economy and you? The event has highlighted the vulnerability of banks that rely heavily on deposits and invest in risky, illiquid assets, and the challenges they face in adapting to changing economic conditions and customer preferences. As a result, many people may be wondering how they can protect their money in case of a bank collapse. In this video, we will provide you with some tips to safeguard your deposits and investments and minimize the impact of a banking crisis. What is a bank collapse? A bank collapse is a situation where a bank is unable to pay its depositors or creditors because it has run out of money or assets. This can happen when a bank makes bad loans or investments, suffers from fraud or mismanagement, faces a sudden withdrawal of deposits, or experiences a loss of confidence from the public. A bank collapse can have serious consequences for the economy and society. When a bank fails, it can disrupt the financial system and cause a chain reaction of problems for other banks, businesses, and consumers. For example, a bank can reduce the availability of credit and money in the economy. This can make it harder for businesses to borrow funds for investment and expansion, and for customers to get loans for mortgages, cars, education, etc. A bank failure can erode trust and confidence in the banking system. This can lead to panic and contagion, where depositors rush to withdraw their money from other banks, fearing that they might also fail. This can create a liquidity crisis and force more banks to close. A bank failure can also affect the wealth and welfare of depositors and creditors. Depending on the level of protection offered by deposit insurance schemes or government guarantees, some depositors may lose part or all of their savings if their bank fails. Creditors may also face losses if they cannot recover their loans from the failed bank. And lastly, a bank failure can also have a spillover effects on other sectors of the economy. For instance, if a large bank that serves many tech startups collapses, like Silicon Valley Bank did in 2023, it can hurt the innovation and growth prospects of those companies. Similarly, if a major lender to farmers or small business fails, it can affect their production and employment levels. Silicon Valley Bank collapse. Silicon Valley Bank, SVB, a key player in the technology startup ecosystem and a prominent lender, suffered a dramatic collapse over a 48-hour period on March 10th of 2023, marking the second largest failure of a financial institution in US history. This devastating event has raised concerns and sparked debates regarding the causes, implications, and ramifications of such a collapse on the banking sector and the economy. The root cause of SVB's collapse can be traced back to its investment decisions during the pandemic. As the pandemic raged on and consumers splurged on digital services and gadgets, many tech firms relied on SVB to manage their payroll and other expenses, resulting in a surge of deposits. In turn, SVB invested a large proportion of these deposits in a long-dated US government bonds, including those supported by mortgages, viewed as a safe investment that would yield stable returns. Unfortunately, the rapid rise in interest rates to curb inflation significantly impacted SVB's bond portfolio, causing it to lose a substantial amount of value. Bond prices have an inverse relationship with interest rates, resulting in a decline in bond prices as rates rise. Moreover, the harsh economic conditions of the past year, especially the regulatory scrutiny and competition faced by tech firms, led to many of SVB's clients withdrawing their deposits. With insufficient cash on hand, SVB was forced to sell its bonds at steep losses, further exacerbating the situation. The panic that ensued when customers and investors became aware that SVB was short on capital led to a classic bank run. Although SVB attempted to raise $1.75 billion from investors to cover its capital shortfall, it failed to do so. As a result, California regulators shut down SVB and handed it over to the Federal Deposit Insurance Corporation, FDIC, which typically liquidates a bank's assets to pay back its customers. The collapse of SVB has sent shockwaves throughout the financial market and raised concerns about a broader banking crisis. It has exposed the vulnerability of banks that rely heavily on deposits and invest in risky illiquid assets. Furthermore, it has highlighted the challenges that banks face in adapting to changing economic conditions and customer preferences, in addition to raising questions about the regulatory landscape efficiency. The impact of SVB's collapse is far-reaching and may have serious implications for the tech sector and the economy. It may disrupt lending and financing for startups and established tech firms that relied on SVB's services. Moreover, it may erode confidence in other banks catering to similar niches or markets. Furthermore, it could contribute to a slowdown or recession if it leads to tighter credit conditions or lower consumer spending. The aftermath of SVB's downfall is likely to be felt across multiple sectors and industries as businesses grapple with the fallout of this significant event, the global banking crisis of 2023. The United Kingdom is confronting a formidable challenge, with its people experiencing the greatest decrease in purchasing power in 70 years. As attested by the Office of Budget Responsibility, the government's independent forecaster. The announcement comes in the wake of government's unveiling of a new budget and assuring the public that the country will avoid a recession this year. Despite this reassurance, the UK still faces the prospect of low growth and high debt, which the OBR attributes to Brexit's deleterious effect on business investment. Meanwhile, the European Central Bank is resolute in its fight against inflation, having raised its interest rates by 50 basis points, despite calls from some investors to hold back on policy tightening until turmoil in the banking sector eases. The deposit rate now stands at 3%, marking the highest level since late 2008. In Japan, top companies have made a monumentous decision, having agreed to most of their extensive pay increase in a quarter of a century during annual labor talks. These companies heeded Prime Minister Fumio Kishida's call for higher wages to counterbalance the rising living costs that people face. Such a decision may have far-reaching implications, including stimulating consumer demand and the prompt ending of ultra-low interest rates by the Bank of Japan. The US Consumer Price Index experienced an annual increase of 6% in February, the smallest it has been since September of 2021, and the 8th consecutive month that the annual rate has decreased. Nevertheless, price increases remain high, which resulted in divided opinions among economists about whether the data will prompt the Federal Reserve to raise interest rates next week. Argentina faces a disconcerting economic situation, with its annual inflation rate surpassing 100% in February, which marks the first time it has reached triple figures since a period of hyperinflation in 1991. Inflation has increased to 102.5%, and consumers witness price changes on almost a weekly basis. In Turkey, the government's measures to minimize the economic impact of last month's earthquake have caused the budget deficit to widen to TRY 170.56 billion, $9 billion in February. Economists believe that the government's spending on rebuilding and aid efforts could alleviate the deficit to GDP ratio above 5% this year, which is more than the government's target of 3.5% set in September. The European Union finance ministers have approved broad principles for the reformation of Europe's fiscal rules to better accommodate investment and provide greater flexibility to reduce debt for high-debt countries. Public debt has surged to the government's pandemic support and the cost of living crisis, which is presenting a challenge to the current rules. Moreover, there is a pressing need to invest in public initiatives to combat climate change. Lastly, Lebanon's commercial banks resumed their open-ended strike on the 14th of March, following legal changes that permit borrowers to repay foreign currency loans at old official exchange rates, which was instigated by the Lebanese pound's 98% plunge in value. According to the banks, this has drained their foreign country reserves, leaving them with insufficient liquidity to pay back depositors. Record central bank support to ailing banks. Central banks around the world have been taking measures to shore up the ailing banking sector, with nearly $200 billion offered so far in direct support. The US Federal Reserve, in particular, has guaranteed all deposits at Silicon Valley Bank and Signature Bank, with the former's deposit guarantee alone amounting to $140 billion. The Swiss National Bank has also offered Credit Suisse an emergency loan of $54 billion, with hundreds of billions more made available to the combined UBS and Credit Suisse. These efforts come back as banks have been borrowing record amounts of money from the Fed this week, with nearly $153 billion borrowed, surpassing the previous record set during the 2008 crisis. Additionally, banks have drawn almost $12 billion in loans from the Fed's newly established emergency lending program, which aims to prevent more banks from collapsing. The $318 billion loan by the Fed to the financial system is approximately half of what was extended during the global financial crisis, but is still a substantial amount. JP Morgan's Michael Feroli commented that the glass half-empty view is that banks need a lot of money. The glass half-full take is that the system is working as intended. Despite the substantial support offered by central banks, the banking industry has also stepped up, with JP JP Morgan Chase, Bank of America, and Citigroup among the 11 lenders providing a $30 billion cash infusion to shore up confidence in First Republic Bank. Meanwhile, HSBC has reportedly committed over $2 billion to SVB's UK business, which it recently acquired for €1. As the banking sector faces ongoing challenges, it is heartening to see both central banks and banks themselves taking measures to safeguard the stability of the financial system. While the scale of support may be the cause for concern, the situation appears to be under control, and the glass remains half full. Is there any risk that more banks might fail? The collapse of SVB was not a singular event in the troubled landscape of the banking industry. In fact, many other banks have been facing similar challenges that have eroded their profitability and stability. These challenges include low returns on their loans and investments, high exposure to fluctuations in interest rates that affect the value of their assets and liabilities, and massive outflows of deposits as customers lose trust in their solvency. In a desperate attempt to save one of their peers from going under, 11 big banks have pulled together a whopping $30 billion to rescue First Republic, another bank that specializes in serving affluent clients and tech companies. These developments reveal a deepening fragility and vulnerability in the banking sector, especially among niche lenders that focus on specific industries or markets that may be more volatile or risky. The Federal Reserve has been trying to calm the nerves of the market by injecting emergency funds into the banking system and reassuring investors that it will do whatever it takes to support the financial stability. However, this may not be enough to ward off more bank failures if interest rates keep climbing or confidence keeps crumbling. Tips to protect yourself from a bank collapse. A bank collapse is a rare but devastating event that can cause panic and stress among depositors and investors. It can also disrupt the financial system and the economy. In the light of recent failures of Silicon Valley Bank and Signature Bank, many people wonder how they can protect their money in case their bank collapses. Here are some tips to consider. Research the financial health of your bank. The first step is to check how well your bank is performing financially. You can look at its annual reports, ratings, earnings, capital adequacy, asset quality, liquidity, and profitability. You can use online tools such as Bankrate or Bauer Financial to compare different banks to see their ratings. If your bank shows signs of weakness or trouble, you may want to switch to a stronger, more stable one. Keep deposits under FDIC insurance limits. The Federal Deposit Insurance Corporation, FDIC, is an agency that protects depositors from losing their money if their bank fails. The FDIC insures up to $250,000 per depositor per insured bank for checking accounts, savings accounts, money market accounts, and certificates of deposit, CDs. If you have more than that amount in any one bank, you may want to spread your deposits across different banks or use types of accounts that are not insured by the FDIC, such as brokerage accounts or mutual funds. Diversify your deposits. Another way to protect your money is to diversify your deposits across different types of accounts and investments. For example, you can use online savings accounts that offer higher interest rates than traditional banks, CDs that lock in fixed rates for a certain period, treasury bills, T-bills, that are backed by the full faith and credit of the US government, or money market funds that invest in short-term securities with low risk. By diversifying your deposits, you can reduce your exposure to any single bank or asset class. Invest in physical assets. Physical assets such as gold, silver, real estate, or art can also serve as a hedge against a bank collapse. These assets tend to retain their value or appreciate over time, regardless of economic conditions. They can also provide income or liquidity if needed. However, physical assets also have their drawbacks, such as storage costs, maintenance fees, taxes, and volatility. Therefore, they should not be your only form of protection. Consider alternative investments. Alternative investments such as cryptocurrencies, peer-to-peer lending, crowdfunding, private equity, or venture capital can also offer opportunities for growth and diversification during a banking crisis. These investments are not regulated by the FDIC or other agencies, so they carry higher risks, but also higher potential returns. They may also be more accessible, transparent, and flexible than traditional investments. However, they also require more research, due diligence, and expertise before investing. Therefore, they should be used with caution and moderation. Monitor your bank's financial health. Finally, it is important to keep track of your bank's financial health regularly. You can sign up for alerts, newsletters, or reports from your bank or third-party sources. You can also check for news or any signs of trouble and instability at your bank. If you notice any red flags, you should act quickly and move your money elsewhere before it's too late. A bank collapse is rare, but a serious event that can affect the economy and society in various ways. As a consumer or investor, you can take some tips to protect yourself from a bank collapse, such as diversifying your deposits, checking your bank's financial health and ratings, monitoring macroeconomic regulatory conditions, taking advantage of deposit insurance schemes or government guarantees if available, and being prepared for possible disruptions or delays in accessing your deposits if your bank fails. Thank you for watching this video on what is a bank collapse and how it can affect the economy and society. We hope you learned something new and enjoyed the content. If you did, please give this video a thumbs up, share it with your friends, and subscribe to our channel for more informative videos like this. Also, don't forget to hit that bell icon to get notified whenever we post a new video.